Well, let's close the books on the third quarter. Now it's time to get ready for what could be a rocky fourth quarter. Despite the pretty good gains we've seen in the fourth quarter past 2 years, our next guests are cautious going into the end of the year, and they're joining me now to tell you how to prepare for the volatility that could be ahead. Springer Financial Advisors, Keith Springer with me, Russell Investments, Eric Rasubin, Glenn Meads, Jason Pride, and our own Rick Santelli. Gentlemen, good to have you on the program. Thank you so much for joining us. All right,
Thanks for having me.
Who is worried about the fourth quarter? Eric?
Well, yeah, I'm worried about the impact of the fiscal cliff debate. If we go over the fiscal cliff, the U.S. goes into recession. The math is actually just arithmetic, and it's not that complicated. We don't actually think we're going to do that, but we think the debate will be uglier than it needs to be, and that will likely create a lot of volatility in the fourth quarter.
Now, we are expecting an earnings comeback in the fourth quarter, but do you think, this is a question I'm asking everybody today, do you think that the contraction that we're expecting to see for third quarter earnings is priced into the market, or is this going to be unexpected?
I don't think it's priced in, a major contraction's priced in. All of our valuation methodologies, we've actually pretty heavily discounted all year long consensus earnings. We're actually applying about an 8% discount to consensus earnings, and even at that point, we think equities represent good value, particularly related to other asset classes.
Keith, what do you think? We are expecting a negative showing for the quarterly numbers for the third quarter. Is it priced in or not?
Yeah, it's already priced in. Everybody's been expecting this, Maria. People have been looking for a negative. Everybody's expecting. We've got to remember, we're in a very sensitive period right now. We're in earnings pre-announcement season. You don't get companies coming out saying earnings are going to be better than expected. Right now, for the next week or so, you only get the ones that are going to underperform or get less than expected. Makes people nervous. Investors need to be cautious for the short term. But we've had a trend for the last 3 or 4 years where earnings have come in better than expected. We go into earnings season lower, the market pulls back, and then once earnings are announced, the market then starts to go up because all the bad news is built in, and I don't think this time is any different.
Yeah,
you know, investors need to invest for need, not for greed. For
sure. Rick Santelli, we've had a tough 2 weeks, though, for equities. Toughest 2 weeks in a couple of months. Do you think the Fed boom is wearing off?
Well, you know, I don't suspect that the Fed's going to get any boom out of it personally. And on mortgage side, we've seen rates come down on a 30-year mortgage maybe 20, 25 basis points. You know, so to go from 389 to 359 or 369, I personally think that, you know, that amount of basis points isn't really going to alter anything. But it is helping stocks. But I do think, you know, the election could change so many things. It could make the fourth quarter great. It could make the fourth quarter less than great. But one thing we know for sure, there's going to be a lot of volatility right about that time. And when I think about high frequency trade and flash crash and how it affects the market on calm days, I shudder to think what kind of activity we're going to have if we get sweeps by either the left or the right on November 7th in the marketplace.
Yeah, that's a good point. All right, Jason, we're looking at the third quarter now, ending. You come into work on the fourth quarter. What are you going to do? What's on your agenda as the director of investment strategy?
Sure, Maria. We actually agree with a lot of what your other guests have said here. There's a lot of risk surrounding the fiscal cliff. Our base case is they'll end up being pushed on and not dealt with immediately, and therefore that risk will be removed or pushed off to another day. In the meantime, there is a supportive economic backdrop. It's getting a little bit better, and the Fed's supportive. So you need to take risk, but not too much risk. What that means is don't buy just equities. That means use high-quality equities, dividend growth stocks, not high dividend yield stocks. That means concentrating your portfolio in things that will produce a good return, not underperform inflation like cash and treasuries, but deliver a long-term return to you along the way.
All right, so are you still looking at dividend payers as a good place to invest, even if we were to see dividend taxes go much higher because of that fiscal cliff?
So we're proponents of dividend payers, but there's a qualification here I need to add in. It's dividend growth companies, not high dividend yield companies, not your highest payout companies. It's intentionally the companies that are able to generate a sustained and regular growth of that dividend throughout time. It's high quality equities we want to focus on, not just any equities that pay a dividend.
All right, we'll keep watching. Thanks very much, gentlemen. We appreciate your time tonight.